Investing for beginners. How to grow your wealth and build a strong financial future. Are you a saver or a spender? If you choose the first option, you can consider yourself part of the larger group. Approximately 59% of Americans responded to a survey conducted by Charles Schwab in 2019 and indicated they regarded themselves to be savers. When you compare these statistics to more recent ones, however, you will notice that 63% of respondents, who come from a population that is comparable to the one described above, are currently living paycheck to paycheck. It is quite clear that there is a gap between the monetary objectives we have set for ourselves and the actions we are doing to bring those objectives to fruition. Many of us are instilled with the belief that saving money is the surest route to accumulating riches and obtaining freedom from one's monetary obligations at an early age. However, this is just a myth. Even if conserving money is the most important step in working toward either of these objectives, using that money to make intelligent investments brings them much closer to reality. The rational fear that prevents the majority of individuals from investing is the fear of experiencing financial loss rather than experiencing financial gain. When we put in a lot of effort at work and are self-disciplined enough to reduce our consumption and put that money into savings, it is natural that the prospect of losing those dollars makes us feel uneasy. Because of this, we make sure that our funds are safe by keeping them in a bank account that is insured by the FDIC. The issue is that the value of the money that we deposit into our accounts will almost certainly decrease over time. Because the interest rates offered by savings accounts are so low, they cannot even keep up with the rate of inflation. As a result, the longer we save, the less purchasing power our money has. However, there is some positive news to report. You can lower the risk element, improve the reward factor, and generate real returns if you make the correct judgments and invest in the appropriate locations. This will prevent you from having the feeling that you would be better off in Vegas. As you get started, there are a few questions that you should think about. Why should you put your money into it? The question of whether or not one should save money or invest it comes up frequently in the world of finance. On the other hand, these are only two sides of the same coin. When it comes to amassing wealth, saving is an essential component of the financial toolbox. This is not because saving generates money on its own, but rather because it provides the capital that is required for investment. Investing enables you, at the very least, to maintain purchasing power in the face of rising prices brought on by inflation. The potential for compound interest, also known as growth gain on growth, is the primary advantage that can be realized from pursuing an investment strategy with a long-term time horizon. How much of your money should you put away in savings as opposed to investing? The most appropriate response to the question of how much you should save is as much as possible, given that the motivations that bring individual investors into the market are always different. The best place to begin is by setting aside 20% of your income, as a general rule. Indeed, having more is almost always preferable, but in my opinion, having 20% allows you to build up a respectable amount of cash throughout your career. At first, you should use these savings toward the establishment of an emergency fund, with a balance that is about equivalent to 3 to 6 months' worth of your typical costs. After you have established an emergency savings account, you should invest any additional funds that aren't being used to pay for specific expenses shortly. This capital has the potential to grow if it is invested sensibly and kept for an extended length of time. How exactly do financial investments work? Having a firm grasp of the market. The term market is commonly used in the realm of finance to refer to a physical location or virtual platform that facilitates the buying and selling of financial instruments such as stocks, bonds, and other assets. Avoid using your personal bank account if you want to enter the market. You must open an investment account, such as a brokerage account, which you then fund with cash. After doing so, you will be able to purchase stocks, bonds, and other investable assets using the money in your account. This can be done through well-known companies such as Schwab or Fidelity, and the process is very comparable to that of opening a bank account. Stocks versus bonds. Companies that are publicly traded can use the market to raise capital for their operations, growth, or expansion by issuing stocks, small pieces of ownership of the firm, or bonds, debt, both of which are considered forms of debt. To put it simply, when a corporation issues bonds on the market, it is essentially asking investors for loans to raise money for its organization. The bonds are purchased by the investors, and the corporation is obligated to repay the investors, together with an interest rate, in the future. On the other hand, stocks are just little chunks of a company's equity that may be bought and sold. Once a business transitions from the private to the public sector, its shares become available for purchase and sale on the market, signaling that the company is no longer privately held. The price of a share of stock usually reflects the value of the company, but the actual price is set by what buyers and sellers are prepared to do on any particular day on the market. Making and losing money when you acquire something on the market. The difference between the price you pay and the amount you sell it for determines whether you make or lose money. A stock that was purchased for $10 and then sold for $15 results in a profit of $5. If you buy something for $15 and then sell it for $10, you will incur a loss of $5. Gains and losses are only realized or counted when you make the sale of the asset. This means that the stock you acquired for $10 could decrease to $6, but you will only lose the $4 difference if you sell the shares for $6. You might decide to hold on to the stock for a year and then sell it when it reaches $11, resulting in a profit of $1 per share. Are you making reasonable investments? It is time to start thinking about where you want to place your money, now that you have a basic understanding of how investing works. Keep in mind that the calculated risk is the best kind of risk that an investor may take, as a general rule of thumb. But how exactly can you be determined? How do you tell the difference between a safe investment and a high-risk investment? In all honesty, the terms smart and risky are relative to each investor. You may determine where you are on the risk spectrum by looking at your circumstances, such as your age, the amount of debt you have, and your family situation, as well as your risk tolerance. In general, younger investors who have a significant number of years till retirement ought to have riskier portfolios. This longer time horizon provides investors with more years to ride out the ups and downs of the market, and it is excellent for investors to continue contributing to their investment accounts during their working years rather than withdrawing money from those accounts. However, someone who is already retired or who is very close to that age is far more susceptible to shifts in the market. If you keep your day-to-day spending money in an investment account, you run the risk of being obliged to withdraw that money while the market is experiencing a downturn. This would not only reduce the size of your portfolio but also increase the likelihood that you would suffer severe losses on your investments. A portfolio with a higher level of risk would most likely contain a substantial amount of equities and fewer bonds, if any at all. As young investors get older and realize they need to lower the amount of risk in their portfolios, they should gradually reduce the amount of money they have invested in stocks, and gradually raise the amount of money they have invested in bonds. The ups and downs of life will have a greater impact on your investments than you may know at this point. If you are honest with yourself about the state of your finances right now, you will have a better understanding of how and where to invest your money. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.